You're listening to Storage Nerds Podcast, where we unravel the best-kept secret of the real estate investing world, the storage industry. Join the grassroots guru in self-storage, Stacy Rossetti, in insightful discussions about finding, funding, and running these spaces, allowing you to yield the highest returns possible. Get your foot in the door on self-storage and discover how to properly purchase facilities, negotiate with sellers, and close the deal without worries. Start unpacking that investment wisdom with Stacy right now.
So the one thing I wanted to talk about first is I want to talk about the difference between primary, secondary, and tertiary markets, because we're going to focus on really finding facilities today. And in order to find a facility, you really have to know the differences between all the types of markets in the industry. Let's get started and talk about all the different markets so you have a better idea. When I'm talking about primary, secondary, and tertiary markets, what am I meaning? Okay. So this is what it's going to look like. So let's just say that we're talking about like Nashville. Okay. So this is Nashville. And inside Nashville, you're going to have your primary market. Primary market is where, this is the primary. And primary market is when where you're going to like, most people live in primary markets, you'll say. And this, when you search on Google Maps and you search storage near me, what comes up? Is there a lot of like Cube Smarts and extra space storages and, all these bigger players, what's it called? Public storage, U-Haul, this kind of stuff. Okay. So those are all primary market players. And then there's also there's also other primary market players, like let's say maybe Monster or Life Storage or Compass. And so those you're going to kind of see, those are bigger players. And a lot of times in these primary markets, like bigger primary markets, they're going to be like maybe double story or tri-story storage facilities, nicer facilities and stuff like this. In the center of Nashville, this is what you're going to see. All right. That's the competition. Now in a primary market, your cap rate, right? Your cap rate is your NOI divided by your purchase price. But the cap rate is really kind of like in the commercial world, cap rate is just this number that really describes where your market stands in terms of what the purchasing power is in that market, right? Really, a lower cap rate is supposedly less risky, and then a higher cap rate is more risky, okay? I don't really agree with that, but that's what everybody says in the industry. Okay, so in the primary market, you're going to typically be 4 to 6%. Now, let's just compare, let's compare Nashville, Tennessee to Savannah, Georgia, okay? Nashville, Tennessee to Savannah, Georgia. So Nashville, Tennessee, we know is just like this big metropolitan area. And there's this huge primary market. And then there's all these suburbs around like Murfreesboro and all these other suburbs around Nashville. Okay. If you are living, let's say in Murfreesboro or like one of these other suburbs around Nashville, and you're searching and you're still finding all these bigger players and all these bigger storage facilities, you are still in a primary market. Now, let's talk about Savannah, Georgia. Now, obviously, Savannah, Georgia is, it's not a big town, but it's like 200-300 people, so it's kind of a bigger city, right? And inside Savannah, when you're in the downtown area of Savannah, you're going to find bigger players as storage facilities there. But the truth is that primary market is like kind of small, right? Compared to the Nashville primary market, right? Nashville primary market is going to expand out to all the suburbs. Whereas like a primary market in Savannah would be just like, maybe in just the town of Savannah itself. And then outside would be considered secondary market. Okay. So you got to really pay attention to what areas you're looking at, when you start looking for deals. Secondary markets are typically 6 to 7% cap rates. When I put the percentage, that's the cap rate. But a secondary market is going to be either there's two different types of secondary markets. One of them is going to be maybe the suburbs of a primary market. for instance, like Savannah's suburbs, like Pooler or whatever, those areas would be considered a lot of times secondary markets. You may have some bigger players there, like as in like maybe Monster or like, some smaller, bigger players there, but you're not going to have lots of REITs there in these secondary markets. So for instance, I live in Tallahassee, and like inside Tallahassee is a town of maybe like between 200,000 and 300,000 people, depending on the school year, right? So it's really the same size as Savannah. And we have a lot of storage in this area, and it would be considered a secondary market. But there's only I think one extra space and 2 CubeSmarts. But then there's King Storage, and King Storage is like a secondary market kind of bigger player, and they have like really big facilities, but they're like, in Savannah or in Tallahassee. You have these like secondary market bigger players that are not like REITs. And so, and then you have in secondary markets, you can, a lot of times you're going to have just standalone cities, like Tallahassee is a standalone city. Doesn't really have a lot of suburbs. Tallahassee is just a big city and everybody lives in Tallahassee. Savannah is just a city and everybody kind of lives in Savannah. There's not a lot of suburbs like around that town. You think about in the state that you're living, what states are considered secondary markets that are not suburbs of primary markets, okay? So for us little people, we should be focusing on secondary market or tertiary market facilities. So, I'm going to put here tertiary market, and tertiary markets are typically going to be, let's do 7 to 8% or 7 plus, right? But we're not seeing a lot of high cap rates. And back in the day when I started, you used to see a lot of high cap rates, but now you're seeing 7 to 8 is a good, 7 plus is a good tertiary market cap rate. Now you can get the cap rate higher when you manage it properly, but when you're buying, typically you're going to be running your numbers depending on your market, because when you get the deal analyzer, if you decide to purchase the deal analyzer, either my deal analyzer or however you're running your numbers, you're going to want to know what is the market cap rate. And the market cap rate is based on the area that you're looking for in your facility. So if you're looking at a primary market, you can't run a cap rate at 8%. If you're looking at a tertiary market, you don't want to be running your numbers at 4%. So you really want to understand your market and understand what the cap rate of your market is, because that plays a major role in how you run your deal analysis. What I want to talk about next is the population of these areas. So in a primary market, obviously primary markets to me are going to be maybe 200,000 plus, maybe 150 to 200,000 plus for the population of that area. Let's say 150. 150K plus for population. So when you're starting to get bigger cities, 150 or so, 1,000 people, then you're okay, I'm probably in a primary. If you're in a town of 150,000 people and there's no primary market players, then you should really be looking at that area. You know what I'm saying? That's a very good area to be investing in, to maybe build something. And then you have secondary market. Secondary market populations are going to be from, let's say, 50,000 to 150,000. So that's that kind of big city, but these secondary markets are not attached to suburbs. No suburbs. All right, we'll get to that in just a second. And then the tertiary market, the population of those towns is 25K to 5,000K. So I would say 25,000, 25 to 5,000. And so tertiary market just means country, little tiny towns in the middle of nowhere country. For instance, in Georgia, we have Albany, Georgia. It's a nice big town. It's got almost 20,000 people, 25,000 people. No, it's probably got 15 to 20,000 people. A lot of people, 15 to 20,000 people in a little tiny area is kind of a lot of people, right? You got to have storage in those areas. It's just that it's not going to be bigger players. It's probably not going to be any secondary market players, and it's not going to be any primary market players. It's just going to be mom and pops like us, right? So when you think of the market and you think of cap rates, you're going to think primary, secondary, and tertiary markets. And you're going to think 4 to 6% cap rate, 6 to 7% cap rate, or a 7 to 8% cap rate, maybe 9. I don't know. Maybe you can get up to a 9 cap now. I'm not sure in a super tertiary market. So now, right, we're going to be looking at in the market, you have primary. Let's do primary. You have secondary and you have tertiary. In between these areas, this is not like a normal term that a lot of people say, but I call these sub-primaries, okay? Subsections, I guess, subsections. So you would have like a sub-primary area, and then you would have a sub-secondary, and then you would have a sub-tertiary area. So sub-primary to me means the suburbs of like a primary market, okay? So, and then also there's like a major storm going on here. So if I get dropped, I'm sorry. So sub-primary to me would be like, we're buying a facility right now in Carrollton, Georgia, right? Carrollton, Georgia is a suburb of Atlanta. It's like, maybe, it's like outside of the Atlanta area. And it's growing very fast area. Sub-primary areas are obviously, going to be more expensive. The cap rates are going to be the cap rate is like, it's going to still be 4 to 6, like just like this one, 4 to 6. But, the cap rate is going to be a little bit lower than the primary market. So for instance, I'm selling 3 facilities right now in the Atlanta market. And, I'm doing Fairburn. If you didn't see my pitch, you missed it. But like from Fairburn to Noonan to Franklin, it's like Fairburn is definitely like primary market. And then Noonan is secondary market and Franklin is tertiary market. And that is all like from Fairburn to like from Atlanta to Franklin is maybe like a 45-minute drive. And Franklin may be considered a sub-secondary market. It may be not a tertiary market. Maybe it's a sub-secondary market. But the population is only like 12,000 people for Franklin. So really it'd be considered a tertiary market. But since it's on the outskirts of Noonan, maybe you could consider that also a sub-secondary market. Does that make sense to y'all? Am I making sense? Please say yes or no in the chat. But, so you want to just kind of like understand, because it just cap rates get very difficult to figure out, especially when you're near primary markets and you're trying to figure it out. So like we ran our numbers at 7 cap, honestly, for, to sell the properties. But the truth is probably Fairburn, we could have gotten a 6 cap. And then Noonan, we could have gotten maybe a 6.5% cap rate. And then Franklin would have been like a 7 cap or something, if that makes sense. But we ended up just running all of our numbers at 7 cap just to make it a better deal for everybody. So you want to think of that. So you want to think that in terms of like, location of the facility equals like what the cap rate is going to be. And so it's kind of hard to determine, but you can always just like, pick a cap rate like this. I said, this is kind of a good way to start. And then if you really ran, like if you went like with a realtor, like let's say you hired Marcus and Millichap to sell your properties, they would look at all your numbers and then they would come up with like 6.38% cap rate or something like this is what they would do. But for us, when we're running our numbers, you just round it up. It's not a big deal. It doesn't really change that much. So this is the 6 to 7%. And then this is going to be the 7+%. Now, a sub-tertiary market, I would consider this to be 5,000 or less. And a sub-secondary, probably like, 50 to 75,000 maybe. Something like this. I don't know. Let's do it. No, sub-secondary, I say 40K to 60K or something like this. Okay. Right. And then the sub-primary, and also sub-primary too, like Carrollton, I think only has like maybe, I think was like 50,000 people or 40,000 people in it. So suburbs, even though the population is still like 40,000, it'd still be a sub-primary market. So population is not, I guess I'm going to erase this because I don't like this. I guess population is not that important in the, in the subsections, just know, I just want to make sure that y'all aren't confused on that. So let's do that. But yeah, sub-tertiary is 5,000 or less. So I was talking to a guy earlier. So so he's interested in doing the coaching program. So just so everybody knows, the coaching program is open. It's just go to storagenerds.com if you're interested. But I was talking to a guy just right before this. He can only afford a couple $100,000 to buy his first facility. This is what he can afford. So he has to be looking in tertiary markets, right? Because, as you go through this, this is going to be more expensive. I mean, if you have millions of dollars that you can buy in primary market, right? If you can come up with $1 million, then you could probably buy in a primary market if you wanted to. We use that as a down payment. But if you can only come up with like 50 or 100 grand, which is typically most people, I would say most people 300,000 or less for a down payment on a property. And you're doing what's reverse engineering, right? Reverse engineering, because you're trying to figure out what areas you should be focusing on of all these areas to look for facilities. All right. And so that's the purpose of the conversation, is trying to figure out, where should I look? And so when you think of primary and secondary and tertiary markets, you're going to be, and you're going to be in the $3 million plus purchase price for this, $3 million plus. On average, maybe you can find a diamond in the rough, but like I'm telling you, a lot of times that's like few and far between, especially nowadays. Like when I got started like 7 years ago, I was finding diamond in the roughs everywhere. But it's kind of harder now. It's a lot more work to find those. And then the sub-primary. So I'm buying my facility, the next facility we close on, in Carrollton, Georgia. Carrollton, Georgia, for me, I would consider that a sub-primary market. It's a suburb of Atlanta. And, even though there's like 40,000 people there, so I'm purchasing that facility for $1.4 million. $1.4 million. So you could probably get, in some suburb, like some sub-primary areas, properties for between $1 and $3 million. Just to give you guys an idea. 1 million to 3 million. That would be, I'd say, for the most part. Now, when you get into secondary markets, secondary markets, I would say probably are going to be between $1 and $3 million. Unless you find just like somebody that has been in that secondary market since it was a tertiary market, and then it became a secondary market. And you want to look for, areas like what used to be a tertiary market, but is now a secondary market. And you might be able to find some of those diamond in the roughs in those areas. So a secondary market is going to say 1 to 3 million. Now, a sub-secondary market is going to be like, I'm going to say anywhere from I say 500,000 to 1.5 on average. So for instance, we bought a facility in Valdosta, Georgia, which Valdosta has 75,000 people, right? So that would be considered a secondary market, right? But then, and Valdosta does have a few suburbs of that town. And one of them is actually Bemis. Bemis is where we actually bought, if anybody knows, if we bought that facility, it was right on the border of Valdosta and Bemis. And north of us is a little town called Bemis. And so that would be considered a sub-secondary market. And like once you start kind of going out into those areas, the prices get cheaper and cheaper. So you might be able to find a diamond in the rough. But like our competitor from that property that we bought is King Storage. Remember I told you about King Storage? And they have like this massive, huge storage facility that's probably worth a lot of money. I'm guessing it's a huge facility. It's probably like 300-400 doors. So, that's probably worth like, $4 million. And that's a sub-secondary market. So you can find more expensive properties in these areas, but you can also find this type of facility. So I'm going to say sub-secondary is going to be maybe 500K to maybe, let's say 2 million. That's a good average, I think. Okay. And then now in the tertiary market, so now we're going into these towns that are like, 15, 20,000. And there is a lot of towns like this in your state. Find these towns because these are gold mines. There's not a lot of competition in these towns. And, and they're just mom and pop owners. The only thing with tertiary market is that, they're mom and pop owners. So they really want to know you. Like you need to be the type of person that goes out and connects with these owners. Okay. So you can't sit there. Like every owner I talk to is like, everybody calls, they all want to buy my storage facility. I tell them to send me an offer, and nobody ever sends me an offer, and nobody ever comes here. Like nobody goes there. And these tertiary market owners, they want to know, like, and trust you. So our process when we talk to tertiary market owners is hop on Zoom, and let's talk on Zoom and introduce ourselves to each other, and then go out and meet the owner. One of us, somebody on my team, is going to meet that person. And a lot of tertiary market owners, they don't want to do business like with anybody that doesn't come to meet them. And another thing too is they will not show you financials unless you're like right there with them. I would tell you, out of 1 out of 10 owners is like this. And they basically say, like, look, I'll sell my property. I'll take an offer. Come here, meet me, and I'll show you my financials. And that's really, a lot of owners do that. This is where the gold is, honestly, especially if you want to get started. I mean, these are great property. Like we got one under contract. It's in the Panhandle of Florida. It's 66 units for $200,000. I mean, it's worth $500,000-$600,000, and we got it under contract for $200,000. And there's also a car wash on the property, which taking up a half of an acre. And we're going to just, take that down and add some more units. And we picked up this property, in a tertiary, in a small little town for $200,000. And she's full. The property's full. Right. So, I mean, and the one thing I love about tertiary markets as well, too, is that the tenants stay for a long time. Right. So primary market turnover is all the time, because, I mean, who wants to pay $300 a month for 10 years? Nobody wants to do that. But a tertiary market, people will pay $50 or $100 a month for like 5 or 10 years. They just do, so that's another reason why I love tertiary markets. So it's like, don't discredit these areas, and go out and find facilities in towns of like, 5 to 25,000. Talk to the owner, go and meet them. And these properties, I mean, you can find some expensive properties. I mean, the more doors they are and the more filled up they are, then the more expensive they are, right? But, you'll find, I mean, typically, 200-300 doors is the most. So I would say probably $2 million. So I would say in a tertiary market, you can find stuff for $50,000, all the way, $50,000 all the way up to like, $1.5-2 million in a tertiary market. Yeah. So let's say 50K to 2 million K. Right. And then, but most of the time, and especially in sub-tertiary, you'll be at like 50K to, 500K in a sub-tertiary. So now you kind of have an idea of like this is all the different markets in the commercial world, and kind of how you should be looking at them. And then you have the cap rates, right? So when you run deal analysis, you know what number to use. And you also have what the population is of each of these areas, just to give you kind of an idea. Now, there's always anomalies. Yeah, anomalies. You have kind of an idea overall. This is what it's looking like. And then on top of that, now you have the price range. So you're like, okay, I can probably afford a 500. Because I was talking to another guy earlier. He emailed me. He was like, look, I can afford $500,000. I was like, okay, well, you need to be looking at really like, tertiary to sub-secondary markets is what you need to be looking at. So when I'm telling somebody you should be looking in tertiary to sub-secondary markets, this is exactly what I mean right here. So hopefully that gives you an overview of where you should be. And somebody said, Tamara says, what is the size of the tertiary market? Tertiary market's right here. Tertiary market's right here. 25 to 5K. And we have 50 to 150 and then 150. Okay. Sub-tertiary is 5,000 or less. So hopefully that gives you an overview of like what the market looks like out there. And this is what I'm seeing. I used to teach just primary, secondary, and tertiary markets, but like as I started getting deeper into like all the different types of markets out there, I really broke it down to even deeper level, because I've just noticed there's a lot of differences, because a lot of people were thinking like, oh, I could just go to the suburbs. That's a secondary market because the population's only 40,000 people or whatever. But that's not how it works. Suburbs are considered primary market. So if you cannot afford expensive facilities, then you should not be looking in your suburbs. You should not be looking in the suburbs of your town. You need to find secondary, sub-secondary, tertiary, and sub-tertiary markets. All right. And then another thing I really wanted to get into too. So that's the market. And what I wanted to get into also was just all the different ways that you can invest in self-storage, because and what the different types, because like I've been asking on my application, one of the things I ask is like, when you envision yourself buying a storage facility, and actually you guys can answer this after we go through this, you answer this question as well too. But the question on the application is, when you envision yourself buying a storage facility, like what kind of a storage facility do you want to buy? What type of facility are you interested in? And like, I always get like random answers, like big ones or something, but there's actually 6 different ways to invest in self-storage. And so now I'm going to go over the 6 different ways and the different types of facilities out there so that you have an educated idea of like what types of facilities are out there. Okay. And like now, and then after I teach this, you guys tell me which of the 6 you're interested in. So the 6 ways to invest in self-storage. And we're going to start out first with what I do. I buy mismanaged facilities. Mismanaged. There's 2 things. There's a couple of things about mismanaged facilities that you should know about. First of all, the rent prices suck. Okay. Rents are not what they should be. Rents are not market rents. All right. So that's like, I guess that's the right way to say it. I say rents suck. Rents are not market, rent sucks. It's funny. It sounds like Lillian. Okay. So rents are horrible. All right. So 1, you get to raise the rents. Number 2, vacancy or occupancy. All right. Can be increased. Occupancy sucks. All right. So it's 50% full. It's 25. We actually have a facility. We have 3 facilities under contract right now. The vacancy is 20. The occupancy is 25%, and the vacancy is 75%. Right. So that is clearly a mismanaged facility. He's charging good rates, but he's not full. So maybe the rates are like too high, or he's not doing enough marketing to get people into the door. Or there's a lot of things that go into that. But mismanaged facilities are one of the 6 ways. Another thing with mismanaged facilities is that there's a lot of appreciation. The price is low. Appreciation high, low price. Another thing about mismanaged facilities, most of the time you have to come out of pocket in order to stabilize the property. All right. So you have to come out of pocket. And it could be, 3, 6, 9, 12 months or whatever. We've had to come out of pocket. So for instance, the 3 that I just told you that we have under contract is 25% full. The value of the property, all 3 of the properties, is worth less than a couple $100,000. So it's like worth $200,000. And we are buying those properties for $1.2 million. Why would I spend $1 million more on the property than what it's worth? All right. Anybody answer that? Answer that. Why would I do that? Because the appreciation on the back end is high, right? The appreciation, and actually the price is low. Because when I stabilize those properties, they're worth almost like $2.5 to $3 million. I'll make minimum $1 million plus on that property, but I will have to come out of pocket every single month for 1 year in order to stabilize that property. That makes sense? That's mismanaged facilities. And it's really like, it's not renovations. It's just like, that'd be maybe add a gate or, put some security in, but it's just management of the property and getting the property leased up. That is what you're doing in the mismanaged facility sector. This is what we do. So every facility I own, the rent sucks, the occupancy is low. I'm double or tripling the value of the property over the course of 2 to 3 years, but I have to come out of pocket every single month. So like, we don't have any cash flow, no cash flow. We have a huge amount of net worth, but no cash flow. That's number 1. Number 2, the next one's income producing properties. So income producing properties means that you got cash flow, right? The rents are at market rate. The occupancy is good. Occupancy is decent. or better. Now, the bad thing is that there's only a little bit of appreciation on the back end, right? You can't buy an income producing property and double the value of that property. So there's a little appreciation. The price is okay. You're paying like top dollar for something like this. And so, but some people, they want cash flow, right? They want to get rid of their job and they want to just have cash flow. So then you need to be focusing on income producing properties. You cannot, like, mismanaged facilities are going to take you a year to make money. So all of the facilities in my fund, in the Self-Storage Fund of America, are mismanaged facilities. And I tell my investors, you need to give me 12 to 18 and possibly even 24 months to be able to pay you a distribution, because every facility I buy is not making money, and it will take that long to make money. So that's income producing properties. Now, the next one is conversions. Conversions are where you take a building and then an empty building, and then you add storage inside of it. This is like super popular right now. In fact, the Leesburg facility that we just bought in Leesburg, Florida, was a conversion. It was an empty building, and the owner put storage into it, and then it really was a mismanaged conversion, is what it was. But conversions are a great way to get into the business, right? So you could build this out yourself, or you could buy it completed. Now, the thing is they're expensive, because to buy an empty building, either completed or you have to build it out, right? Then that it's going to be, the building itself is going to be expensive, right? Because, big commercial buildings are expensive. And then, right? And then let's see, if you build it out, and then you have to go through the whole like pre-development process. You have to go through, if it's not zoned, you have to go through getting all the permits, doing the whole build out process. So you have to do the build out process, which is you build it out yourself and you go through the permitting process. Or you can just buy it complete and buy it done. All right. Another thing about conversions is that these are typically climate controlled. So climate controlled, there's a lot more maintenance in climate controlled facilities. There's a lot more maintenance in owning the building. So we have to worry about the ACs. When are they going to crash? When do we have to update them? The roof, how does that look? This kind of a thing. So there's a lot more upkeep and maintenance. But the good thing about conversions is that it is climate controlled. So, typically climate controlled facilities are anywhere from $150 to $250 a square foot. And, so there are a lot, you get more money for the facility. So you're going to make more money, but you do have higher utilities. Right. But you're getting, on average, $2 a square foot. And if you can go out and find a really good deal, like on a building that's, been sitting there, and then you can convert it. Conversions, you can make a lot of money. You can double the value of like we just bought our Leesburg one, and we will double the value of that property. And we got it owner finance too as well, so that's conversions. And then we have new construction. So new construction, right? You got to have a strong stomach for new construction. New construction takes forever. But over the course of the next couple of years, from now until maybe end of 2025, the way to make money, the way to make a lot of money in storage is going to be new construction or mismanaged facilities. If you want to build out a conversion or build out a new facility, you're going to be able to triple the value of that property within the next couple of years. Once you get it leased up and stuff, it takes time to do that. And then, mismanaged facilities as well, too. Find super crazy properties and then, manage them properly. But it takes forever. There's a lot of upfront money. I'm going to just put upfront money here. Right. And then you got to go through the pre-development process. And you've got to get zoning, and you've got to get the permits. So we have in our coaching program, on the first and third Tuesdays of the month, we have our mastermind for all the students. And yesterday we had one of our students, his name's Philip. He owns a storage facility in Texas. And then he also works for a company that builds storage facilities. So he came in and he talked about like the whole new construction process, talked about the industry, what's going on, what do you have to go through? And like to get to the actual like phase where you're building the facility takes forever. You have to go through, you have to find the land, buy it. First you've got to get it approved to be able to do the, to build the facility. You got to clear it. You got to get the site work. You got to civil work. You got to make sure that you're getting everything approved. And then after you do all that stuff and finally get your permitting process, then you can start building. And that still takes like several months to even do that. So just know, and there's a lot of upfront cost in doing all that. You just have to know that you have to have a strong stomach in order to do construction. But the truth is if you can build, you will make the most amount of money that you can make in all of the industry through this sector right here. So if you are up for the challenge, like we have one student right now that's building, and he has been working on this thing for a year and a half. He got one building done and he's working on a couple more buildings. And it's just like, he's just like, going through the motions. He has a very good personality where he's just like stressful, but he's like also just kind of pushes through and stuff. That's the kind of personality you want to have. We used to build on the residential side, and I'm going to tell you, I do not have that personality at all. Like I was like stressing out. I was pissed. I was like yelling at everybody. Pete and I were arguing all the time. And so like, we just decided that new construction is like not for us, so we focus on, mismanaged facilities, but some people got it in them. So if you think you got it in them, this is the best way to make money in the industry. And then let's see. And then then also we have wholesaling. We got some time? Yeah, we got time. Good. So wholesaling is wholesaling. If you haven't heard of wholesaling, this is where you have, and then you have your storage facility. All right, that's your storage facility. And then you have this person here. You have the buyer, the seller, and you. You find the storage facility, you find the buyer, and you find the seller. That is what wholesaling is. And you're going to find this facility and you're going to buy it for, $500,000 from this person, and you're going to sell it for $550K from this person. And in the middle, you get to make $50K. That's wholesaling. And all it is just contracts. They sign a contract. All right. That's what it is. It's like paper. You're the middle person. You're the broker. There's a little more rules into this. I get into the coaching program a lot. And this is in my course. So if you're interested in learning about wholesaling, I go really deep in the course on how to do wholesaling. So, you should check that out. Well, wholesaling is a great way for you to earn money. And like I said, and you're earning the big bucks, right? So $50K is a good amount of money. I bought a storage facility. I bought 2 storage facilities from 2 different wholesalers, and they each made either 125 or 150 grand off of me. I paid each holder. It wasn't $50K. It was $150K. They're more expensive facilities. They weren't $500K. But when you buy $3 million facilities, you're okay with paying $150,000 to the person that brings you that deal. And that is how wholesaling works. It's a great way. If you're listening to me and you're like, I don't have enough money to do this, this is what you should be doing. Wholesaling self-storage. In our coaching program, we have people that are just wholesaling self-storage. So you can do this. You just have to learn the rules and the laws on how to do this and go through that. And another thing too is in the coaching course, you have access to my contract, and my contract is an assignable contract. This contract right here needs to be assignable, which I get into in the coaching program, but you'll have access to my contract in the course, in the coaching program too, but in the course, because I go really into this in the course. So that's wholesaling. Okay. Wholesaling is another way to get into the industry. And then finally, we have lending. What I'm telling you, all of the different 5 ways of getting into self-storage and buying a storage facility, I'm going to tell you, it ain't easy. It's a lot of work. After you own the facility, After you've got it up and running and automated, not a lot of work. I was talking to one student. We found a facility for him through turnkey acquisitions. And so he didn't even have to do any of that work at all. But and then he got it up and running. He bought it in December. So I just had our quarterly meeting with him on today. And he was like, it's a lot easier than I thought. He's like, but he like, I said, like, well, how were the first 90 days? He's like, oh yeah, the first 90 days were crazy, like craziness. But I mean, essentially, we found him a facility, and he spent 90 days chasing tenants, getting it up and running, automating everything. And now he's barely even doing anything with the storage facility, but the first, to find a facility and then to get it up and running, to get it to where you are automated. I'm going to tell you, it ain't easy. It's a lot of work. And if you don't want to put the time and effort into doing that, then you should just lend your money out. Right? Lend it out. So partner, find somebody that will, will do all the work for you. Partner with them, right? Lend the money out. Be the silent partner. Be the person, be the person that lends the money and just makes the money. And ultimately, if you really want to get into, real estate investing, your long-term goal should be this. Your long-term goal should not be, I want to own, 1,000 storage facilities or whatever. Your long-term goal should be, I want to make enough money so that I can just lend my money out and make money on my money. This is your long-term goal in real estate. And, this is your long-term goal. And I want to say also long-term goal here. This is the easiest way to make money, lending your money out or investing your money. So you can lend, you can partner, you can put it into a fund, you can JV. JV means JVing would be hey, yeah, we're 50-50 partners. I'm going to do this and you're going to do that. We're going to work together. We're going to do this as a team. And then but you could also be a partner, a silent partner, right? And just be look, here's your money. Here's my money. You do all the work. You're the boots on the ground person. I'm the money person. Or you can find a fund, right? And then you could just passively put your money into a fund and let that asset manager make the money for you. So this is this is passive. This is true passive income. Owning a storage facility is not passive income. It's one of the most passive ways to make money in the real estate world, but it is not true passive income. Only this is true passive income. I mean, if you only have to wire money over and then you get a check every single month, that's passive. Those are the 6 different ways to invest in self-storage. Look at that. That's pretty good, huh? So you've got mismanaged facilities, income producing properties, conversions, new construction, wholesaling, and lending. Of all of the list here, what are the ways that you're interested? Put into the chat of all these 6 ways, what appeals to you the most? I'd like to know that. So go ahead and put that into the chat. And so, yeah. And then somebody said, is my fund for accredited investors? My fund, the fund that I have right now is for accredited investors. We closed on a fund, last month, and that was for non-accredited and accredited investors. So every once in a while, we do syndications where we allow non-accredited investors, but the fund that I have right now is only for accredited investors. Okay, and that's the Self-Storage Fund of America. That's the one I'm going to pitch tomorrow at 1:00, so you can hop on. Okay, good. So I see wholesaling. Okay, who's doing this? So Malu says wholesaling as an initial strategy. Okay, good. And then Rachel says mismanaged for now. And Holly says mismanaged and wholesaling. And Felipe says mismanaged and then lending. Good. Tamara says mismanaged, income producing, maybe wholesaling down the road. And then Mark says mismanaged would be my goal, but wholesaling or income producing may need to come first. Okay. And then Keith says mismanaged. Good. And Ben says mismanaged and lending. Good. You should, you know what? I'm going to tell y'all, you should be mismanaged and lending, right? You should say income producing and lending. I love the and lending on the end because that ultimately should be your goal. You want your money to work for you and you don't want to have to do anything to make that money. My lenders, I have one lender that over the course of the 10 years, he gives me $2 million, but we've been using that $2 million for 10 years. And he has made so much money off of me. Oh my gosh, he made a ridiculous amount of money. And guess what? He came to my very first property 10 years ago, and then he's never seen any property that I've ever bought with his money since then. That is true passive income. And I just pay him on a monthly basis. Okay, good. Christopher says, where can I find information on syndicates for non-accredited? So a non-accredited investor, you want to look up 506B funds. B is in boy. Okay, 506B is non-accredited. This is where you don't have a net worth of $1 million. Okay, and then a 506C is for accredited. And then also an A, C or A. All right, so that's what you want to look for. 506B is a non-accredited. You can do any, like there's all kinds of non-accredited. There's not a lot of non-accredited storage facility funds, just so you know. But there are a lot of 506B funds, okay? And then income, Lydia, so I was going to say, Lindy says income producing and Flippus is mismanaged to learn the business and the ultimate goal is to lending. I love it. Yes. Okay, good. Let me make sure I answered all the questions, and I think then we'll just wrap it up. How long does it take to build clientele with conversion versus the prior to? Oh, yeah. So the lease up phase is one new tenant a week, and you lose one tenant a month. That's how you should run your numbers. So I teach every week, this time every week for free. So just hop on, listen to me. But again, this is only going to take you so far. Buy my course, buy the deal analyzer, go through the training sessions, and then hop on this. That's like the triad. That's my teaching triad. You want to do, a free course. Oops, sorry, let's not do free course. Let's do free webinar. And then we have the deal analyzer. And then you have the course. You can get all this at stacyrossetti.com. This is the winning way to storage, or the coaching. The coaching is storagenerds.com. Okay, Samir bought the course. Good. Okay, good. All right. Yeah, just go to storagenerds.com if you want to talk to me, and then go through the application process. And that's going to guide you to my calendar. Thank you, Stacy. Very interested. Where can you find? Just Google 506B funds, because I don't know, honestly. And then Mark by Coaching, is that the legacy group? Yes. Exactly. Just apply through storagenerds.com, click on that, and then just go through the application process. Okay. All right. I appreciate you guys hanging out with me today, and I will see you guys next week. All right. Take care. Bye.
Thank you for joining us for this episode of Storage Nerds. Hope this informative conversation inspired you to go out there and jump into this highly profitable business venture that people rarely talk about. Get more tips on storage space investing at www.stacyrossetti.com. Don't forget to subscribe to the show and leave a rating. Together, let's build that thriving passive income one storage space at a time. Until next time.